today's webinar on Ecosystem Marketplace's recent report, Raising Ambition, the State of the Voluntary Carbon Markets 2016. On behalf of the other presenters, I'd like to say how delighted we are to see so many of you have joined the call. My name is Grattan McGiffin. I am the Commercial Director at Olcott, the Sustainability Solutions Provider, and also co-chair of the Climate Markets and Investment Association's Forestry, Land Use and Voluntary Carbon Markets Forum. We have several CMIA members on today's presentation, and for those of you who aren't, allow me to give a quick plug. The CMIA is the voice of the climate, sustainable finance and services community. Governments and policymakers across the world recognize CMIA as a leader among progressive trade associations with regards to incentivizing low carbon and resource efficient investment through market mechanism, pre-compliance markets and climate and sustainable finance mechanisms. Eligibility to join is open to all non-compliance carbon firms. So the webinar will start very shortly. We're just waiting for a few more people to connect. In the meantime, I'll describe the format. First up will be Kelley Hamrick, the report's lead author, who will present the macro trends, buyer preferences, and the role of voluntary offsetting in a post-Paris world. She will be followed by Sean Penrith, Executive Director of the Climate Trust, who will give his insights on North American carbon market dynamics and how the Climate Trust is helping to address the challenge of upfront carbon financing. And after Sean, we'll say Jambo to Marc Baker, who's co-founder and Director of Operations at Carbon Tanzania. Marc will provide a project developer's perspective from his excellent East African RED project. Now, there are some house rules. Because we have a very large number of attendees, can I ask that all attendees, that all questions, rather, are saved until the end of all the presentations. And at that stage, you can ask questions using the chat facility on the webinar. Additionally, can we just double check that everyone will be on mute for this, particularly people dialing in. The webinar is being recorded and an audio file will be available on the CMIA website later this week. The aim is to complete the presentations and ensuing questions within 1 hour. All unanswered questions can be sent directly to each presenter's email, and they promise me they will answer them. So without further ado, I shall pass the presenter's baton to Kelley.
Perfect. Thank you, Grattan. And thank you, everyone, for your interest in this year's State of the Voluntary Carbon Markets 2016 findings. So as Grattan mentioned, my name is Kelley Hamrick. I am the lead author of this year's report, Raising Ambition, which was a nod to what came out of the Paris Agreement where we saw the High Ambition Coalition. So before I dive into the findings, I just wanted to give a quick thanks to our donors, MacArthur Foundation and Good Energies, our sponsors, Infinite Earth, Biocarbon Partners, EcoAct, and our supporter, the Climate Trust, because without this, none of this would have been possible. So a little bit of background first about Ecosystem Marketplace. We are a Forest Trends initiative that is focused on news and analytics and really providing information around environmental markets and payments for ecosystem services. We have a number of reports besides this one, including an annual State of Forest Carbon finance report, a new initiative focusing on tracking corporate commitments around deforestation called Supply Change, which actually just also released a recent report. And we also will have another report coming up soon that is tracking buyer trends on voluntary offsetting through analyzing CDP data. And a little bit of background on the methodology of this report. So I'm sure many of you might have actually heard from us personally. We typically call over 1,000 organizations that are active in the voluntary carbon markets in an effort to try and capture the full scale of what's going on in this market year over year. So we will call everyone up, we email everyone, we try and make sure we capture all of the current transactions that are going on. Last year in particular, 286 organizations responded with 2015 data, 174 of which actually provided offset transactions data. This was primarily from European suppliers, followed by North American suppliers, and the overwhelming percentage of respondents came from the private sector, though we did have a few nonprofit and public sector respondents as well. And while we attempt to capture 100% of these transactions, we know not everyone responds. And so just a little bit of context, we know that organizations accounted for 3.8 million tons that reported in 2014, chose not to report to us in 2015. And we also tracked another 23 organizations that we think are out of business, who of course did not respond. So then another quick methodology point, we track transactions, which we define as the point of contract between a buyer and a seller. So this can occur at any stage of the project development process, from before a carbon reduction impact is verified to after the generation of verified offsets. And since voluntary offsetting remains unregulated, specific volume and price data is very scarce, and so we produce this report annually to provide transparency around market trends that we're seeing. So this graph shows sort of our headline figure. It shows volume over time. We've tracked nearly 1 billion offsets transacted over the years, and for last year in particular, the number was 84 million tons, which represented a 10% increase over 2014. Most of this demand came from repeat buyers, but 1 in 10 participants were new. And the graph in particular shows different categories we've tracked over time within the voluntary markets. So the light blue represents the Chicago Climate Exchange, which was sort of a big source of demand back in the day, but closed in 2010, hence it has sort of died out. The maroon color shows pre-compliance volumes. So that's primarily just for 2012, when we saw a lot of pre-compliance transactions around the upcoming Australian and California markets. And you can note that for 2015 there is no maroon, and that's because we have not tracked any significant pre-compliance volumes for China, South Africa, or South Korea. And a quick note too, for those of you who follow us every year, we did have a methodology change. We're excluding large public-to-public transactions, such as the Red Early Movers Agreement that was counted in 2013 and 2014. I'm not going to go into detail on that here, but am more than happy to discuss that outside of the webinar. So as you can see here, this is a graph showing value over time, and it looks very similar to what you just saw, but the key difference I think that we should point out is the 2013 to 2015 segment is declining instead of increasing. And this is because buyers paid lower prices on average across almost all project types, which then of course resulted in a lower overall market value of $278 million tracked for last year. So this is the lowest annual injection of new finance from purely voluntary actors since 2006, which it's obviously a concern for the market, and there are a number of reasons for why we're seeing the lower average prices. So I'll be discussing more about that sort of throughout this presentation. But one of the factors I wanted to mention, aside from price competition and built-up supply, which will be discussed soon, is also just something that is a sort of basic thing that might be overlooked, which is conversion rates. So we collect data in local currencies from everyone, which is we then convert to US dollars. And since the dollar has been strong, the exchange rates between foreign currencies and the US dollar fell this past year, particularly in Brazil. So it could be that some of these lower prices might reflect a lower value in US dollars, but could actually indicate a more robust margin in local currencies. If we had used the 2014 conversion rates, the average price would have been 3.6 instead of 3.3 per ton, and the value would have been $306 million, which actually would have been a slight increase from the 2014 value that we tracked. So getting into the actual price, the overall average price we tracked last year was $3.3 per ton, but it is important to note that this only tells the tip of the iceberg. actual pricing remains highly variable. We tracked actual prices that ranged as low as 10 cents per ton to as high as $44.8 per ton. So there really is a wide range of variation that's going on here. But though some suppliers continue to transact at an average of $8 per ton or more, in general we have seen a shift to lower pricing, which is evident in the graph that you're seeing right now. So the bright red color represents the different price ranges and the associated volumes that we tracked in 2015. So as you can see, sort of the largest red spikes are in the $3 to $4 range and in the $0 to $2 range. And we did track that 52% of offsets transacted at less than $3 per ton, which if you compare it to 2014, that was only 41%, and in 2013 that amount was only 40%. So there is sort of a shift that's going on, though of course there is still a lot of variation that's happening. And while it is difficult to explain why a particular offset sells less or more than another, this can range from project type, location, offset age, also known as vintage, the standard use, motivations. It can be a number of factors, but a few trends that we've identified are as follows. The first is the size of transactions. So suppliers that transacted large volumes, be they intermediaries or project developers that have very high annual issuances of offsets. Typically, if there are larger volumes, they are able to offer lower prices and accept smaller margins per ton, but still meet their cash flow needs. So we did track organizations that reported total transaction volumes of more than 1 million tons reported an average price of $2.9 per ton, whereas organizations that were smaller that reported total sales of less than 50,000 offsets total said that their average price was $7.5 per ton. So you can see sort of one possible reason for the spread there. Another sort of key trend is the organization type. So brokers and traders are those who don't actually take ownership of offsets, and their average reported price was in the $1 per ton range, which compared to retailers and project developers who reported an average of in between the $3 to $4 range. So a few other factors which we can't actually quantify in our survey, but we've sort of heard anecdotally from market participants include diversification, where there are organizations that are no longer sort of relying exclusively on carbon finance, and so the lower prices are not a barrier to continued project development. And then there are those that we dubbed in our report as the distressed optimist, who are selling perhaps at below operational costs, but just for the moment, but are then expecting an upswing of demand post-Paris. And then, of course, we always do receive some responses from project participants who are simply exiting the market and seeking a return on their sunk costs. So while the information I've just presented so far has been sort of the big picture trends we've been seeing, I did want to take a step back and look at sort of an even larger context of what's going on in the voluntary carbon markets by looking at issuance and retirement data. So this is actually not our data. This is what is provided to us from standards and registries. And so it's sort of, I think it's nice to look at, the other sort of sides of this coin. So offset issuances increased 6% over 2014 for a total of 42 million tons, bringing it to almost 330 million tons across all years. And since, in this case with issuances, project developers will typically wait to issue until they find a buyer because they can incur a registry fee for each issuance they have. So this should really be seen as a minimum of the total emissions reductions that have resulted from voluntary carbon finance. And another point I wanted to make here, if you look at the graph, so this shows issuances and retirements by different standards across all years to date. But if you look at the 2012, you'll see a bit of a spike, and that was a lot of ramp up from project developers in anticipation of the California markets. which really we believe indicates that the growth of voluntary carbon markets is limited by demand, not by supply. And we expect that developers could quickly ramp up supply, even currently, if there was a clear demand signal, for example, perhaps from the upcoming international aviation negotiations. On the flip side, looking at retirements reached a record 39.5 million tons retired in 2015, a 23% increase from 2014. And this means that over all years, we have tracked 161 almost million tons retired, which is nearly half of the existing offset supply. But when you think about the supply that hasn't been retired, some participants have noted that some of the issued offsets from older vintages, more than a few years old, might be considered stranded assets, since buyers typically prefer recent emissions reductions. So it is possible that some of these older tons might never be retired. And on that note of vintages, we did track, there actually was demand though for old vintages, because 87% of all transacted offsets from last year were from pre-2015 vintages. So it could be that maybe there's just a specific age after which buyers are perhaps not as interested. But it could be that they're still interested but are just willing to pay less. So of the pre-2015 vintages, those sold for an average of $2.7 per ton, which compared to current vintages from 2015, the average price was $4.4 per ton, and post-2015 vintages transacted at an average of $7.2 per ton. So sort of doing a reverse here, drilling down into the details of what are, when buyers did purchase, what are they interested in buying. So looking at project type, renewables were the most sought after project category. So you can see here the light blue represents renewables, and that's the inner circle is project category, and the outer circle is project type. So within renewables, wind was the most common project type, which represented 25% market share for a total of 12.7 million tons. And this has really traditionally been one of the highest transacting types because of both the affordability and the understandability factor of wind. But the average price was lower. It was $1.9 per ton. And it's an interesting case study as well, I think, because you can see there's a large range of variation, not just by project type, but also by location within it. So we did split up and look at wind offsets by location. And so looking at that, Indian wind offsets had an average of $1.2 per ton, whereas US-based wind offsets had an average of $3.7 per ton. And another sort of interesting way of looking at this data is looking at the next most commonly transacted project type, which are red offsets, so reduced emissions from deforestation and degradation. This was the most transacted project type in both 2013 and 2014. And last year, it captured 22% of market share for a total of 11.1 million tons. And so this had a higher average price than wind at $3.3 per ton. But we did see some variation actually if you look within sort of specific methodologies. So if you look within red projects, there are generally sort of two types, and that is avoided planned deforestation and avoided unplanned deforestation projects. And so when you split it that way, unplanned had a higher average price of $5.4 per ton, whereas planned was an average of $1.9 per ton. So this is sort of just another way of saying that, you know, even when we are talking about averages at a more detailed level, you can continue to sort of break it down even further and see that there's still a lot of variation going on. And if anyone's interested in the full list of volumes, prices, and values by project types, we have it for all the rest of them available in the annex of our report. And also a brief note about standards. I don't have a slide because it was sort of an oddly shaped figure, but we did track that 98% of offsets transacted under a third-party standard, so there is pretty much universal awareness and acceptance of the need for third-party verification. The majority of those were from the verified carbon standard. VCS-only offsets consisted of 37.2% market share, and those that were paired with the climate, community, and biodiversity sort of co-benefit standard made up another 12.1%. Other major standards that we saw offsets transact under included the Climate Action Reserve, which had 20% market share, the gold standard, which had 19% market share, and then the full list, of course, can be found in our report. So then one final sort of more detailed look at this can be at the location of where offsets originating from and where are buyers purchasing offsets from. So the figure here, I want to just sort of direct you to really look more at the colors than at the text because I know it's a bit small. But basically the dark blue indicates countries where there were more than 1 million offsets sold from. And the light green is where sort of the smallest amounts of offsets where we tracked offsets originating from. So as you can see, the major project locations are sort of familiar favorites. These include the United States, India, Indonesia, Turkey, Kenya, and Brazil. And in aggregate, North America and Asia were home to the most offsets supplied. But there's another way to look at this data, of course, and that is by looking at the finance that's going back to actual projects versus going back to intermediaries. So splitting the data that way, Latin America actually received the majority of finance going to primary markets, which was 57%, whereas Europe saw the most finance going to intermediaries, which was at 84%. So we do have a full list of the value received by primary and secondary markets by region, information about volume, value, average price, most common standards, most common project types, etc. in the regional analysis of the report. I'm not going to go into full detail here because I could spend probably another hour just talking about that. But also the other point I wanted to make about this slide is on demand, and U.S. buyers purchased the most offsets of any country, which actually was 16.0 million tons and was equivalent to nearly the combined demand across all European countries. The total there was 16.1 million tons. And within Europe, major buyers include the United Kingdom, the Netherlands, and France. And in general, sort of something we could say about buyers is that they typically look close by to purchase, whether or not they were purchasing from nearby project developers or from nearby retailers who then were sourcing those offsets from further abroad. But suppliers headquartered in North America sold 90% of tons to North American buyers, and that's pretty much the same for other regions where the majority was sold within the region, even though the exact percentage, of course, would vary. So then moving on to, I think, what most people are interested in, you know, what do buyers look like? So a quick note here is that these aren't buyers who are reporting to us, these are suppliers who are reporting on behalf of buyers. We had 113 suppliers provide us with this information. And a couple of key points to make about this slide is that most demand came from the private sector. Actually, it was overwhelming at 98%. And primarily, it was from multinational corporations, followed by domestic corporations, and then followed by small to medium enterprises. And primarily, a lot of the common sectors remained that we've seen over the years, which include energy, transportation, and the finance and insurance sectors. But we did also see sort of a surge in interest and demand from the events and entertainment sector and the service sectors, which were the top two sectors we tracked last year. And of course, we also always see demand from other carbon retailers, and so 27 or 24% of buyers were resellers versus 76% tracked were end users. And as I mentioned before, nearly 1 in 10 were a new buyer to this market. And then this was also a pretty cool figure, I think. So we added a new question in the buyers section that asked about what buyers were really looking for and why they selected one offset as opposed to a different one. And so the majority of respondents said that buyers sought offsets that fit within their organization's mission. I'm sort of interpreting that as it was a mixture of sort of the other possible reasons that we had presented. So it could be perhaps a mixture of co-benefits and cost and location, which I think would make sense because I honestly expected that we would have seen a higher percentage of respondents reporting that project location was a primary preference, since that was something that I had heard sort of anecdotally from a lot of market participants I had spoken to, whereas that in this case only amounted to 4% total. We did have a couple of additional questions that were relating to co-benefits and project location, which I think are also interesting to note. So if a respondent said that co-benefits were the primary concern, we asked which ones, and those were primarily biodiversity and community benefits. And same for project location, we tried to sort of drill down at what point in the value chain was of most interest. And so buyers who were purchasing offsets by project location were most interested in those that were near the buyer's supplier's locations. And so I think we are sort of running out of time, so I'm not going to spend a whole lot of time listing all of these off, but sort of the key point that I wanted to make here is that the 2015 report was really a 10-year report that sort of aggregated all of our historical data and was looking sort of historically, whereas with this report we actually we're trying to look more in the future and try and look at demands to watch. And so we actually have a lot of breakout boxes within the report that sort of look at all these different potential developments in more detail. So I don't want to spend a whole lot of time listing out each of these, but a couple of ones I think that a lot of people are watching right now are, of course, the role for voluntary offsets post-Paris, the upcoming aviation negotiations, the role of renewable energy certificates, RECs, and whether or not they will familiarize buyers with environmental markets or if they will shift demand from offsets back to RECs. There are also a number of organizations working on developing either new metrics or trying to quantify new assets, and maybe trying to quantify actually co-benefits where they can provide an alternative finance stream. Also, what we've noticed are some new voluntary commitments, typically based more around carbon neutrality commitments with no explicit mention of offsetting, but these could perhaps result in latent demand in the future for voluntary offsetting. There are also several initiatives going on right now that are really trying to address these recent low prices by either guaranteeing above average pricing or setting price floors. And then finally also supply chain management. As I mentioned before, we have another initiative within our department that is tracking corporate commitments to zero deforestation. And so far we haven't really seen a lot of companies making the connection between forest carbon and zero deforestation, but this is something that we are keeping an eye on, as well as the fact that more corporations might be engaging in what we call insetting, so trying to offset emissions but within their supply chain. So with that, I think we are more or less, I think, back on track with time. And so I'd like to conclude there. I would encourage everyone to really look at the report. There are a lot more details presented in there that I just honestly cannot fit within this presentation at the moment, but definitely read that and definitely reach out as well if you have any specific questions about the report. So thank you.
Good morning. This is Sean Penrith. Hopefully you can see the screen. Kelley, you did a great job of covering some main points. I may skip over some areas. So I'm going to cover hope, opportunities, concerns, and finance. I'm the Executive Director for the Climate Trust. We are a 19-year-old NGO based in Portland. We've shifted our model somewhat beginning in 2016, where we have launched a fund focusing on land-based sectors to offer upfront finance in an early stage. So to me, when I read the report, the upshot is we're up in volume, down in price, which is not necessarily a great thing. However, it's a reflection of our cumulative global ambition. If you've read this study by Jenkins and Karplus, you see that we are woefully below the aspirational levels of carbon pricing that we actually need. The majority of pricing around the world is around less than $15 a ton. So can you see this okay? I don't know, somebody, Ali, you're asking me to make my presentation full screen? Seems to be full screen here. Yes? No?
Yes, we're just seeing the timer, so if you could just make it full screen on your screen.
Yeah, it is full screen on mine. Let me see. How does that work? Does that work?
Yeah, that's a bit better, sure. Yes, there you go.
Okay. All right, good. Where was I? Yeah, so to us there's a tremendous amount of positive news. If you track the nationally determined contributions leading up to Paris, those were the country plans. Around half of them reference market mechanisms in reaching their targets. As Kelley mentioned, there was a number of different associations, coalitions, and commitments, including the Under 2 MOU. The big one for us, of course, was Article 6 in the Paris Agreement, which recognized ITMOs, and I'll cover that a little bit further. And a lot of the internal carbon pricing, specifically in North America, we work with a number of those multinationals that Kelley mentioned in the entertainment and finance industry. They are indeed repeat customers. We don't see a lot of new entrants on the voluntary side. And remember, the Climate Trust deals with voluntary and compliance, and so we're able to track both. The good thing about the outcome of Paris is, to us, it triggered the onset and the commitment to carbon pricing and carbon mechanisms around the world. And if there's any repeat of what happened in California, where we saw a ramp in the transition of credits from the voluntary sector to be used as early action in California, which attributed 11% increase, we're hopeful that these other schemes in Ontario, China, Korea, and others will have a bearing. Here in Oregon, we're discussing a cap and trade. There's a study bill right now, and there's a tremendous opportunity to include voluntary offsets in some of the larger state plans, and I'll go into that a little bit more further on. So if you followed Article 6, it talks about internationally transferable mitigation outcomes, ITMOs, which is code word for essentially offsets and allowances, carbon instruments. It also talks about creating robust accounting measures and a registry to allow for a trading exchange. These are very, very positive signals. The other outcome that came out of Paris was the Carbon Market Declaration. 18 countries basically said we want to aim high, we want to develop standards and ensure environmental integrity. And I think this will be a very strong driver for markets, both compliance and voluntary. So our particular resonance with the report, again, Kelley covered some of these, 10 cents to $44. The Climate Trust works with voluntary corporate buyers, and we transact in the $10 to $12 range. However, that's very much driven by the report findings of type and location, which is a little challenging because it creates a bottleneck constraint. If you're trying to match a project with the buyer, it's difficult to get to scale. We also see a number of the projects that we've invested in from moving from voluntary to compliance. So we work in the dairy digester, forestry, grasslands sectors. And some of those projects we've invested in here in the Pacific Northwest specifically are migrating to California carbon offset instruments for California use. As I mentioned, we don't have a lot of new market entrants. Each year we work with our corporates. They pretty much want to work with us, and this is, our impression is that it's driven by contractual ease. A lot of the corporate buyers are somewhat challenged by the contracting due diligence process of suppliers. They come to the Climate Trust, they know that we have been around a while and that we're fairly easy to transact with, and that helps support this repeat buyer aspect that we see. The pricing driven by type, $1 to $2 in wind and landfill. Obviously, we work a lot in the forestry sector, as I mentioned, and we are getting very charismatic prices for our credits. We worked, for example, on the Alaskan island of Afognak to create a forestry project there, and we were able to transact those into multinational buyers. I think there's some positive hope that in 2016 offset issuance is projected to generate around 70 million metric tons from the land use, forestry and renewable energy projects. I mean, these are charismatic areas. We see a lot of impact investor interest in these because, you know, this really appeals to rural economic development, the heartland, the breadbasket aspect of the country, and so we're encouraged by that. A couple of emerging opportunities. One is the Clean Power Plan. Again, Clean Power Plan is specifically looking at capping the electric sector. However, it offers a tremendous opportunity for states that are designing their state implementation plan to land on what they term a mass-based plan, which is essentially a greenhouse gas cap for the state. It also allows for multi-state interlinkage. And any state that opts for this route under Clean Power Plan compliance is essentially creating the infrastructure for a cap and trade so that the state can then include non-cap sectors. And that's exactly what's happening in Oregon and a number of other states that we are interacting with. The report also touches on the CEQ revisions to the greenhouse guidelines. I'll talk a little bit on another slide about that. In our discussions with ARB down in California, it's been interesting. They were very clear that the compliance market needs the incubation process of the voluntary market. If we did not have the voluntary market, it would be very difficult to on-ramp compliance protocols. We've seen that with the protocols that are accepted into California now. One of the sectors that we work with is the grassland sector, voluntary. We transacted with Chevrolet. And because of the piloting and the incubation of that protocol, it is one that may well be considered for inclusion under the California system. And we need to see more and more of that. Another really interesting piece is the pilot auction facility. World Bank developed that for international piloting. There's a number of entities in California that are looking at a path for markets down there, but we think there's tremendous opportunity for someone like USDA, for example, to offer a pilot auction facility to really support the voluntary sectors. So this is the piece I was talking about in terms of CEQ. If you're not following it, there was an executive order calling for agencies to reduce their footprint by 40%. And when the rule was written in 2012, essentially what they said was carbon offsets in the voluntary sector are just untested. We don't have a lot of confidence in their rigor. We're concerned about double counting and so on. And the good thing about the report is that it talks about the 98% of 2015 offsets were verified by a third-party standard. And this point we've made very clear, along with our colleagues at CAG and EDF, to the Council, that in 2012 there may have been some doubt, but today there is no doubt that we have that rigor. And if the CEQ guidelines were amended to allow just 8% of anticipated reductions being used, that could jumpstart the US voluntary market by 15%, would be significant. This is the pilot auction facility. I'm going to skip that. I think the warning signals we have to be careful of are the Cal Chamber ARB lawsuit, which is challenging the legality of auctioning allowances. In the event that had a negative effect on a ruling, that would put pause to a lot of the integrity of a market. Even though the ruling would not affect AB 32 and the cap and trade, it would send a shockwave signal. Clean Power Plan, apparently the Supreme Court on Monday argued that they were going to remand the decision to the lower court and protect the Clean Power Plan. This is good. This is very good news. If it went the other way, it again would send a negative warning signal. The other thing, if you're following the sentiments around cap and trade versus a federal tax, of course, if there's a federal tax, we would not necessarily have the market that we need in the US. And the big question is what the outcome is on the presidential election. So we need a ton of money to come into the impact space, the conservation finance space. We need to move from 15 billion to 400 billion. We estimate the demand through 2025 between voluntary and 2.89 billion. One of the barriers is early stage funding. And so the Climate Trust has launched Climate Trust Capital, which is a carbon investment fund, and it essentially provides upfront investment to a project and then shares in the equity from the resulting credits that are generated. And we are in our pilot phase. It's a $50 million fund. We'll wrap that up in 24 to 36 months and then scale to $100 million. And what we're trying, our thesis here is that carbon offsets are a reliable asset class that can be banked on to provide market-based returns. All right, thank you.
Great, thanks, Sean, for that deep dive on North America. So, Marc, we're going to Tanzania next.
Good.
Alert from voting meeting V7.17.0. You have been made a presenter.
Can everybody see my screen?
Yes.
Great. Good morning or good afternoon, wherever you might be in the world. It's the sun is setting, 3 degrees south here in Tanzania. Carbon Tanzania is a social enterprise that develops, manages, and also markets our RED projects. So we are engaged in the entire value chain. The cornerstone of the projects that we develop in Tanzania and take to market are based on forest community land rights being in place, the development and promotion of good governance, a respect for community development priorities, biodiversity, rural employment, and of course linking revenue to good management. And I think you can see with the presentation from Kelley and from Sean the importance of many of the co-benefits, these elements within the forest carbon offset that we produce, and many of them of course are also critical to third-party certification. As a network organization, we do this by partnering with other non-government or private sector organizations that also want to achieve what we want to achieve, and we work with the Nature Conservancy who provide technical support. We work with Ujamaa Community Resource Team that work with us on land and community rights, and we also work with the Northern Tanzania Rangeland Initiative, which links us into a number of different partnerships. And the key here is that it allows us to develop projects with a higher finance need, such as USAID funding, and I will talk about that a little bit later on. Now, I'm presuming many of the people in this audience understand that deforestation accounts for between 15 and 20% of the world's carbon emissions, and certainly in the Paris Agreement and the good science shows us that we need to address deforestation if we are to be serious about reducing CO2 emissions, and certainly in the context of Tanzania where we live and work, both Tanzania's INDC and in the voluntary space that we develop projects, forestry is the key element here. About 80% of Tanzania's carbon emissions are the result of deforestation and land use change, 70 million tons a year. So what we do at Carbon Tanzania in the context of developing a RED project, reduced emissions from deforestation and degradation, is quite simply preventing deforestation. And to do that, we need to make several very critical steps. Now, just the context of what forests mean. To the local communities, to the Maasai, to the Tatogga and the Hadzabe that we work with in our project development space, these forests are an essential resource for life. And in Tanzania, on average, about 70% of the population derive part of their livelihoods from forests. And of course, as scientists, we look at forests and we see carbon, we see nitrogen, we see water uplift, ecological diversity, we see a global support system. But for the people of Tanzania, for the communities that we work with, what they are essentially is a seasonal supermarket of essential resources. These forests provide livelihoods, provide food, provide grazing for cattle. So when we talk about the context of the carbon offset, we're also, of course, talking about all of these co-benefits associated with forests. These resources are often in many countries like Tanzania, and I'm sure this is the same for you listening in different parts of the world, that the ownership of these resources is often split between different legal frameworks or is linked into the context not necessarily with land. And so the quite high upfront costs of RED development, quite high upfront costs of the ownership of land by the communities and the legal right to manage their natural resources is the key first step. We then have a framework of land use planning, of mapping and working with people to monitor and track land use change, and that's all built in within the context of how the project is designed and the activities specifically that you are putting in place to reduce deforestation and degradation. So the key for us as we've been operating now for about 7 years, and we realized very early on that for us to enable our RED projects to function, we needed to go out there and find the market and develop the market ourselves. And the companies that we work with, and I'll show you an example of a few of those, they are all doing this essentially for corporate social responsibility and to meet sustainability goals. And of course this links into brand value and a competitive advantage in the space in which these companies are working. But of course there's also what the communities get, and at Carbon Tanzania we balance both the marketing of our offset with the community work, and that forms in the function of employment, protecting biodiversity, which is a key element to the Hadzabe hunter-gatherers specifically because they eat a lot of biodiversity. But of course the stress reduction of community land rights and access to education, employment and healthcare, which are all key parts of how our project operationalizes on the ground. So who's buying? Well, for us, our biggest market is within tourism, and you can see National Geographic Expeditions there, offset with us, as well as a wide variety of companies, some consultancy, some Rayburn, some schools. And it's interesting that the market report picks up on this, that we do have very high retention within companies once they sign on and once they start to understand the process of what they're buying into, and that educational process is also a role educating companies that Carbon Tanzania takes on. So in terms of financing, how did we get this up and running and making the model work? Well, pre-2012 we started to approach companies within the tourism space and look at project development. There was a very close connection, of course, with tourists coming to Tanzania and the projects being here, which made a difference. And once we were certified, then from 2012 onwards, we were able to step into a more international market, and you can see that that greatly increased our sale volume. In terms of how that money is spent on the ground, about 20% is there for monitoring, reporting and verification, 60% goes directly to communities, and I'll show you how that's broken down, and about 20% remains with Carbon Tanzania in terms of overheads. Communities, this is an average over the last 5 years. You can see village, district and ward are all forms of our jurisdiction, so you get a percentage that's paid into a government revenue, employment in terms of scout payments, medical fund, and the Hadza community essentially take the rest of that revenue. In terms of financing our project development steps and financing projects into the future, we have a combination of finance currently in operation within the company. HRSV is a social impact investor from Holland. They're working with us specifically in Yaida Valley to expand our Yaida Valley Red project. That's now completed. And we also work with a fund based on a new large-scale forestry project in the Masai Steppe. This project is about 4,000 square kilometers, so a large project area, and this is funded through a consortium of organizations led by the Nature Conservancy by USAID. And our next step is Mohali Ecosystem in western Tanzania. Again, this is a large-scale forestry project linking the national park to forest reserves from east to west and protecting the largest remaining population of eastern robust chimpanzee. And this will be done through a series of forest reserves. So thank you very much for listening. If I don't get around to any of your questions, you're welcome to send me an email. All my details are on the website. Thank you.
Good. Well, thank you to all the presenters for that series of insights. I think now we'll go and answer some questions. Kelley, if you want to have a look at the questions that have been answered, or Ali, we just want to read out some good ones and direct them to the appropriate presenter.
Yeah, so I think it looks like the majority of questions are around whether or not slides. Yeah, so I think it looks like the majority of questions are around whether or not slides will be available. The answer is yes. We can have those available. We can send them out to everyone who has participated in this webinar afterwards. So another question was by Nick DeLeva. How do you see the market for 2016 versus 2015? So I guess at least maybe I can start, and then the other two panelists can chime in. I think there is a lot of optimism that is generated post-Paris, but we've heard some mixed reactions from participants. Some have been saying that they have already seen an influx of new interest from new buyers. So sort of getting back to that, that only 1 in 10 were new this past year. We could actually maybe start to see some more new buyers into the market. On the other hand, though, sort of looking at some of these new commitments that companies are making about carbon neutrality, there are a lot of new initiatives out there, including the science-based targets, where it's really encouraging companies to create emissions reductions targets in line with a 2-degree cap on global emissions. For those, I don't know if we'd expect to see any voluntary offsetting activity immediately, because typically what you see with commitments is that these organizations make the commitments first and then take some time to try and figure out what are the next steps. So I think it could be a bit of a mixed bag next year, but I'll mute myself and see if either of the others would like to chime in with their experiences.
Yeah, this is Sean from the Climate Trust. I would just say that we're also optimistic. A lot of it is contingent on, interestingly enough, the development of the compliance markets, whether or not supported by the Clean Power Plan, and that's because the compliance design offers a tremendous opportunity to incorporate uncapped sectors, ergo the offset sectors. And so the more we see momentum moving in compliance market design, the more support we're going to have for voluntary. I don't think that the standalone corporate commitments will do it alone.
Great. We have a question on what do the presenters feel is the single most likely source of new demand. So maybe we can do a quick round robin if you could answer in just a few words. I think the question was trying to get at if there was a single source, what would it be?
Well, this is Sean. I'll take a crack. There's two: the aviation initiative that kicks off in 2021, and the other is the amendment to the Council of Environmental Quality greenhouse gas reporting guidelines would be absolutely pivotal.
Yes, I think for us, aviation, again, that commitment is big, and we'll see how that develops.
And just to chime in as well, Kelley here, I think also aviation is probably the one that is going to happen most recently, and also that has the most likelihood of actually happening.
Great. So just going in order here, I know we said the webinar would end at noon, but maybe we could stay on for another 5 minutes or so and then address the remaining questions by email. But a question coming in from Marc, what proportion of initial project development or startup costs are funded by donors or investment funds?
Okay, well, there's several different answers to that depending on the project. For YIDA's initial setup, which started 7 years ago, we funded much of the initial setup ourselves, and then started to, by forming the strategic alliances with organizations that wanted to meet the goals that we wanted to meet, we were able to defray a lot of the upfront costs. So by working with other organizations already on the ground or wanting to also achieve a certain goal, we were able to be quite smart about keeping the costs low. To then further develop YIDA, the upfront cost was paid by the social impact investor. Now this is Plan Vivo, so one of the attractive parts of the Plan Vivo project is that the upfront costs can be a lot less than, say, a VCS project. Now with our new USAID funded project, that's again all of the upfront costs are funded. It's a donor funded project, and it's working with partners again with common end in terms of increasing land management, but the specific element that we're adding value to both in Makamo and in Mohali, and this is really a key for this new type of conservation, this investment in the conservation space, and that is to create long-term enterprise, and that's absolutely critical for sound land use planning in this part of the world.
Great, thanks, Marc. Just going in order here, there's an interesting question coming in from Jeff. Do you see any buyers, particularly private sector companies or individuals, wanting more direct involvement in designing, scoping, and implementing offset projects? So probably for Sean or Marc, that would be a great one.
My comment is brief. We don't, mainly because we don't necessarily encourage it, only because we always look at scale, and that to us is not a scalable approach.
Yes, the amount of technical know-how, the background science, the land rights, the need for political engagement make these kind of projects very, very technical and to develop. It's unless that investor was coming with a specific requirement, it would be a very difficult thing to do. No.
Great, thanks. Maybe time for one or two more. I don't know the answer to this. I'd be interested if anyone does. Is there any correlation on the amount of offsets needed globally to move the move the needle on meeting the 2 degrees Celsius temperature rise cap that's kind of set by climate scientists as the maximum we can go?
It's a great question. I don't know.
It's a great question. Yes. You know, you have to remember this 2 degree target set is just a number. When we go beyond 2 degrees, our science just gets a little bit more wobbly, so we don't understand really what's going to happen. I don't think anybody's really been able to work that out, and I think it would be a very difficult thing to do properly.
Yeah, I mean, we know the basically global carbon budget that we have, and we know that we'll blow through it by 2030 or so at the current rate. So obviously that gap can't and shouldn't be filled all with offsets, but we need all the help we can get, right?
Exactly.
Yeah.
Okay, why don't we end with one question about insetting. So this was a trend that we didn't talk about too much in the report, but insetting is essentially verified emissions reductions within a company's supply chain, and looking at the data from CDP, the Carbon Disclosure Project in particular, we're finding more companies are using this as an emissions reduction strategy. So the question is, do you think that the share of voluntary carbon market traded offsets that are actually insets will increase post-Paris? That was for Kelley, but if anyone else wants to chime in, feel free as well.
I think that we definitely could see an increase because I think in general companies are becoming a little bit more sophisticated and are starting to think more about their supply chain, and so I think it's sort of a natural progression when they start looking at their supply chain and looking at their Scope 3 emissions, which are emissions, you know, outside of sort of direct emissions they're making, that they might try and make that link of trying to start insetting or keeping the offsets maybe a little bit closer to their actual operations.
Great. Well, thank you very much for all your questions. I'll pass it off to Grattan for the last word in case you want to say anything else. But on our end, we'll follow up with the remaining questions that have come in via email. We had, I think, 160 participants in this webinar at its peak, so we're really thankful for the interest and looking forward to continuing the conversation. We also encourage you to sign up for Ecosystem Marketplace's free biweekly newsletter, the Carbon Chronicle, where we have news on carbon markets every week. So any final thoughts, Grattan?
Well, thank you very much. We have gone a little over time, but I think it was a very good session. As you said, a record turnout. And I'd echo your comments. If anyone does have any outstanding questions, please feel free to email them directly to the presenter. Additionally, if anyone has any questions regarding CMIA membership or our next webinars, please contact me. My thanks to our panel and to all of the attendees and their excellent questions. So many thanks and goodbye for now.